Good day. Today we'll be looking at IAS 17 and we'll be taking the second part of IAS 17, which is lease. Now, in our previous lesson, we discussed the part 1 of IAS 17 and we gave definitions to terms used in IAS 17. We talked about the terms, we gave the definitions, and now we're in the part 2. We're going to also be treating part 3 and part 4 of lease. The part 3 would take care of the IFRS part of the lease, while here we're dealing with the IAS, which is IAS 17. Now, if we have not gotten the first part of the lease, we should, before delving into this topic or the part 2 aspect of it. Going on to this lesson, we'll be taking the calculation aspects. The part 2 is majorly calculation aspects on all what lease is about, all the terms we gave in the part 1. We would have calculations to buttress our points and make it more understandable with calculations. So the first one would have an example on term of lease. Now, example 1 has X Construction Corporation are about to lease an earth digging machine from another company. Machines of this type usually last for 15 years. The lease is for an initial period of 10 years at a rental of 1 million naira, whatever currency you use, per annum. The contract allows X Construction Corporation to extend the lease for a further 5 years after the initial period at a cost of 150 naira per annum. The question is, what would the lease term be for the contract? Now, from the question, we could get that there are three figures for years. First, we have 15 years, then we have 10 years, then we have 5 years. Now, what we are asked here is the lease term. At first, the initial period, which we learned that the lease term could be divided into the primary period, which is usually the initial period, and a period to extend the contract of the lease. Now we have 10 years as the primary period and 5 years as the period to extend the lease. So in total, we have 15 years as the lease term. Now the machine, according to the question, lasts 15 years. Now this 15 years given here is the economic life of the asset. The economic life of the asset is the period in which, from our previous class, is the period in which the assets provides economic benefits to whichever user that uses it rather. Now, the useful life is different from the economic life, as we said before, but we'll be giving example on that in example 2 later on. Now, we have, from this question, we have 1 million naira per annum for the first 10 years and 150 naira for year for later years, for the later 5 years. The primary period usually recovers a substantial part of the cost of the assets, while the extended period has a minimum part to be gotten by the leaser from the lease of the assets, because he has already gotten most of what he wants from the assets. Now he leases it to the leaser to be extended for his use for a lower amount of money. Now here they said it would seem very likely that X Construction would continue to lease the assets beyond the initial lease term, which is the primary period. The term of the lease is 15 years. So we move over to our second example. We'll be having about 20 something examples, but we'll be going quickly and understandably. to get the difference between economic life and useful life. The example goes, on 1st January 2014, the same X Construction Corporation leased a dredger for 8 months. The dredger is 6 years old on the date. Ships of this kind are usually able to provide 45 years service. Now, most of our questions here are gotten from the old I Can Study pack, so we'll be explaining the examples given and trying to make them more understandable to us. Now, what are we to do here? We're to get the economic life and the useful life in this question. Now, the dredger, we gave a definition of economic life as the remaining life or the remaining parts or the remaining lifespan of the asset from the date of inception of the lease. Now, before the lease, the assets or the dredger here had existed 6 years before the lease. Now, the total economic life or the total lifespan of the lease is supposed to be 45 years. Now, 6 years has been spent out of the 45 years. So, in total, it has 39 years. That's 45 minus 6. 39 years left as economic life. So, the dredger has an economic life of 39 years, okay, which was also said here. Now, we've gotten the economic life. So, what about the useful life? The useful life is the period which the lessee would be able to use the asset and gain economic benefit from the use of the asset. And here it says, on the 1st January 2014, the dredger would have a useful life of 8 months for X Construction Company Corporation, which is the lessee in this question. So we've been able to differentiate between the economic life, which is the total life, and the useful life, which is the period which the lessee alone, that's one lessee, would be able to get economic benefit from the use of the leased assets. So the example would be minimum lease payments would go fast. A finance company has purchased an asset and would lease it out in a series of leases as follows. The first lease is to Company A for a period of 5 years at an annual rental of 10,000 naira. At the end of the lease to Company A, the assets will be leased to Company B for 1 year at a rental of 10,000 naira, also the same price. Company B is a party related to Company A. After the end of the lease to Company B, the assets will be leased to Company C for 1 year at a rental of 10,000 naira also. Company C is not related to Company A and B. So we'll be calculating the minimum lease payment. Now, minimum lease payment has 2 points of view, as we said before, the lessor and the lessee's point of view. And according to the notes here, it says the minimum lease payments from the point of view of Company A and from the point of view of the lessor are as follows. Company A is the lessee, and the lessor's point of view would also be stated. So we have the years. Now, this is the differentiates the minimum lease payments from both points of view. Here, Company A is the lessee and the lessor. So to Company A, the first 5 years which we have here, which was leased directly to him, the asset was leased directly to him or her, is 10,000 each year. Then the 6th year, which is Company B's own, which is a party related to him, would be added to his minimum lease payments as Company A. That's 10,000 for year 6. While year 7, he had no payments to the lessor. While year 7, it was leased, that asset was leased to Company C here, which was not related to either B or A. So the year 7's part goes directly to the lessor's minimum lease payment. So here we can see that if the lessor leases an asset to 2 unrelated parties, that means the minimum lease payment would automatically be different, but if it's just one, the minimum lease payment would be the same. So we have year 1 to year 5 times 10,000, that's 50,000. Then year 6 times 10,000, that's, if you add the total, it will give you 60,000. That's the minimum lease payment for company A, who is the lessee. Now the lessor's minimum lease payments has an extra 7th year of unrelated party also getting 10,000. So his total minimum lease payment is 70,000, while the lessee has a minimum lease payment of 60,000. So those are two figures entirely. Now, in example 4, we have the interest rates implicit in the lease. We are going to be looking at an example on the interest rates implicit in the lease. A finance company has purchased an asset for 50,000 naira, dollars, whatever currency you use, and will lease it out in a series of leases as follows. The first lease is to company A for a period of 5 years at an annual rental of 10,000. After the end of the lease to company A, the asset will be leased to company B for 1 year at a rental of 10,000. Company B is a party related to company A. After the end of the lease to company B, the asset will be leased to company C for 1 year at a rental of 10,000. Company C is not related to company A and B. Same question. At the end of the lease, the asset is expected to have an unguaranteed residual value of 2,573, 2325 The interest rate implicit in the lease is 10%. What we are asked to do is to prove that the interest rate implicit in the lease is 10%. Now, in our previous definition, we gave the definition of interest rate implicit in the lease. Now we have a formal definition for it. It says the interest rate implicit in the lease is the discount rate that at inception of the lease causes the aggregate present value of A, the minimum lease payments, and B, the unguaranteed residual value to be equal to the sum of the fair value of the leased assets and the initial direct cost of the leasehold. Now, in simple terms or informal words, it is simply the percentage that makes all income at present value, all gain from leasing the assets at present value, to be equal to the expenses made, or to the cost of the assets and the direct expenses made on the lease, the initial direct expenses made on the lease. So it's like a percentage that makes the present value of income to break even with the expenses we make on the lease. So we have a table here. The first one, time, narrative, leaseholds, cash flow, discount factor, present value of the assets. Year 0, we have the fair value of the assets, that's the cost of the assets, which was 50,000 here, purchased an asset for 50,000. Then discount factor, at this point we should know how to discount to present value, it's very useful. 10%, year 0 we have 1, so we multiply 1 by the outflow of 50,000, which we get an outflow of 50,000, still the same thing. Then the leasehold's minimum lease payments, that's the payment from year 1 to year 7 as given above. Now the leasehold gets all the payments. It doesn't matter if it's related or not, it still gets all the payments. We have 10,000. Then for 7 years, the cumulative discount factor gives us 4.868, that's at 10%. And we use the 4.868 to multiply the 10,000 each year to get 48,680, 48680. The unguaranteed residual value at year 7 would also be brought down at 2,573. The discount factor at year 7 using 10% is 0.513. So we have a present value of unguaranteed residual value at 1,320. Now, if we look at these three figures, we'll find out that the balance is actually new. So from our question, we're supposed to prove that the interest rate implicit in the lease is 10%. We have a new balance here, so it has broken even. The expense is equal to the income in the lease. The present values of the expense and the income are equal. So we have 10% as the correct interest rate implicit in the lease. We'll move further to example 5, PV of future lease payments. Now, a finance company has purchased an asset to lease out to a manufacturing company. The asset costs 500,000 and has an economic life of 10 years. 500,000, then economic life of 10 years. The lease payment is for 9 years at an annual rental in arrears of 87,000 per annum. Now, from this part of the question, we could already guess, okay, we had the definition of finance lease before, that it occupies a substantial part or period of the economic life. Here we have a 10-year economic life, and the asset is to be leased for 9 years. That is a whole lot of time compared to 10 years. So we could just guess that this type of lease is a finance lease, but we'll look at it further to see if it's true. The interest rate implicit in the lease is 10%. Now we have two views here, the same: the time, narrative, cash flow, discount factor, present value. The year 1 to year 9 lease, the lease's minimum lease payment. I have cash flow of 87,000 naira per annum in the question here, also down here. Then the cumulative discount factor at 10% for 9 years, year 1 to year 9, is 5.759. So if we use 5.759 to multiply 87,000, we get 501,033 as the present value of the minimum lease payments today. So with another guess, we could see that the present value, the amount gotten, is 501,033, is higher than 500,000, which is the cost of the asset. Now in finance lease, to identify finance lease, we could also get from our previous class that the gain or the income takes a substantial, the word substantial, part of the cost of the asset. It recovers a substantial part of the cost of the asset to the lessor. Now 501,033 or 501,033 is more than the cost of the asset. It's even more than substantial. So we could already confirm that this itself is a finance lease. This is more than the fair value of the asset. This lease is a finance lease. Also note that the lease is for a major part of the expected economic life of the asset, which is another finance lease indicator, as we've said before. Now the leases view, this is the same since the asset was leased to a single person, so the points of view are likely or would be the same. So we have the same table here, but this time his own minimum lease payment, which is the same thing since the asset was only leased to him. Same, this is more than the fair value of the asset. This lease is a finance lease. Also note that the lease is for a major part of the expected economic life of the asset, which is another finance lease indicator. So we have example 6. We have present value, PV, of future lease payment. Now a finance company has purchased an asset for 50,000 naira and will lease it out in a series of leases as follows. The first lease to company A for a period of 4 years at an annual rental of 10,000. At the end of the lease to company A, the asset will be leased to company B for 3 years. The first one 4 years, second one 3 years, the same payments, 10,000 naira, and company B is not related to company A. At the end of the lease, the asset is expected to have an unguaranteed residual value of 2,573, 2573 naira, dollar, whatever currency you use. The interest rate implicit in the lease is 10%. Now we are supposed to get both point of view, the leaseholder's view and the lease's view. So we'll take the leaseholder's view first. We have year 1 to year 7. The leaseholder's view doesn't care how many people, it's the cumulative number of people. So it has 4 years plus 3 years, that's 7 years, year 1 to year 7. And the cash flow for each of the year is 10,000 naira. The cumulative discount factor at 10% is 4.868. So multiply 4.868 by 10,000, we get a present value of 48,680. Now we look at 48,680 and the cost of the asset, which is 50,000. It occupies a substantial part of the cost of the asset. So we can say to the leaseor, he can consider this as a finance lease. But let's see what it says. It says this is 97.4%, that's 48,680 divided by 50,000 times 100% of the fair value of the asset. Most would agree that this was substantially all of the fair value of the asset, though IAS 17 does not give a numerical benchmark. This lease is a finance lease. Now we have company A's point of view, that's the lease's point of view. There's an error in the table here because it reflects the same thing. Here the table is supposed to be different. Company A, since it is not related to company B as in the question, supposed to have 4 years instead of 7 years down here. So the time frame instead is supposed to be year 1 to year 4. And the lease's minimum lease payment, that's company A's minimum lease payment, 10,000. The discount factor is supposed to be the cumulative discount factor for 4 years, which should be, I should guess, 3.17. Then the present value will give us 31,700 instead of 48,680. Now the reason why the 2 points of views are different here is because it was leased to 2 leases that are unrelated. We have it in the question here. Company B and company A, they are not related, but here we're looking at company A's point of view. Now this is 63.4%, that's 31,700, that's the net present value of the lease's minimum lease payment to him of 50,000. 31,700 divided by 50,000 times 100%, that's 63.4% of the fair value of the asset. I would say this is not substantial. We could call substantial maybe from 80, the higher 80s to 100 as substantial. But we'll see what it says. It says most would agree that this is not substantially all the fair value of the assets, though IAS 17 does not give a numerical benchmark for the word substantial. It's left to our discretion. The lease is an operating lease, so once it's not substantial, you classify it as a lease when you've looked at the other conditions which we listed out in part 1. Now we move over to illustration 7, which is an illustration on the treatment of land and building. It says a company leases a property for 450,000 naira, dollars, Canadian dollars, whatever, per annum in arrears. The lease is for 10 years and the useful life of the building is 5 years. So we have the fair value for land 2 million, fair value for building 500,000 rather, fair value of leasehold interest on land 1 million, fair value of leasehold interest on building 500,000. So when calculating for the lease of land and building in lease treatment, we use the fair value of leasehold interest to get the percentage to divide the payment itself. That's 450,000. Remember, in our last class, we are supposed to separate land from building. Land is supposed to be separated from building, but when they are joined, you are supposed to separate them together from each other, rather. So the rentals are allocated between the land and building in the ratio of 1 million, which is the fair value of leasehold interest in land, to 500,000, which is the fair value of leasehold interest in building. That's 2:1. So the total is 3. For rent in land, we have 2/3 times 450,000, which is the cost, the payments here, annual payments here. 2/3 times 450,000 gives us 300,000, while the rental payment for building gives us 1/3, the balance, times 450,000, which is 150,000. So each year, the part of land paid for is 300,000, while the part of building paid for is 150,000, which gives us the total payments of 450,000 yearly. Now we move over to illustration 8. This will be fast, the double entry on initial recognition of finance lease. Now we are assuming that the assets we are going to lease is a property, plant and equipment, PPE. So we have, you debit the PPE, you credit liabilities. And you're debiting PPE, assets is increasing, and the liabilities. So example 9, we'll have an example here, posting of double entries in finance lease. It says Ibadan Construction enters into a 6-year finance lease of a machine on 1st January year 1. The fair value of the machine at the commencement of the lease was 80,000 naira, and Ibadan Construction incurred initial direct cost of 2,000 naira while arranging the lease. Now we know how to treat initial direct costs. Now the double entry here, we have the property, plant and equipment. You capitalize it, 80,000. You have the liabilities, that's the finance lease obligation, as 80,000 too as a credit. Then also remember there's also a 2,000 here, which is the initial direct cost. The initial direct cost is capitalized along with property, plant and equipment. So we have a 2,000 there. Then the amount spent, whatever is a cost, was expended from bank or cash. So we have a credit of cash or bank, which reduces our cash or bank figure in our accounts. So we credit it. We credit the cash or bank. So this is the treatment of the lease. Illustration 10, posting of finance lease after initial recognition. The illustration here 9 is on initial recognition, while here after initial recognition, also subsequent recognition rather. We have, you debit the statement of comprehensive income, depreciation expense, then you credit accumulated depreciation. Now this is basically depreciation treatment, the treatment for depreciation, because in our previous lesson we learned that finance lease is treated as though the asset itself is owned by the lessee who is using the asset. Now the asset itself is capitalized in the lessee's books and depreciated in his books, while this is not the same for an operating lease. So we'll go over the example 11, calculating annual depreciation charge in finance lease. It says Ibadan Construction enters a 6-year finance lease of a machine on 1st January year 1. The fair value of the machine at commencement of the lease was 80,000 naira, and Ibadan Construction incurred initial direct cost of 2,000 when arranging the lease. The estimated residual value of the asset at the end of the lease is 8,000 naira, The estimated useful life of the asset is 5 years. So we have the work as Ibadan Construction has also incurred initial direct cost of 2,000 naira. The accounting policy for similar owned machines is to depreciate them over their useful life on straight line basis. So we have the basis for depreciation here. Annual depreciation charge. How do you get the annual depreciation charge? So we have the fair value of the machine, which is also the cost of the machine. We have it as 80,000 right here. Then initial direct cost, which is capitalized. Capitalized means added to the cost of the asset. So we have 82,000. Then the residual value is the balance after depreciation has been made. So we have 8,000 as the residual value given to us in the question here. 8,000, we're deducting it to get the accumulated depreciation for the period of the asset. So we have 74,000 as the accumulated depreciation. Now what we were asked was the annual depreciation charge. So if we were to get the annual depreciation charge, we have a 4 years useful life. We'll divide 74,000 by 5 years useful life rather. We'll divide 75,000 by 5, which gives us 14,800 naira, Canadian dollars, whatever amount you use. Now we move over to illustration 12. Amount, we have calculation on the amount owed or the amount left on the lease to be paid. Now we have a format here which says amount borrowed at start of the lease, amount recognized at initial recognition of the lease, which could be the cost of the asset, plus interest accrued, minus repayments, lease on rentals, then also minus repayments of loan principal. Then you get the amount owed. Now that's the current amount the lessee is owing the lessor. We have a note on finance charge here. It says the total rental payment over the life of the lease will be more than the amount initially recognized as a liability. The difference is finance charge. Now the finance charge is a charge to the lessee because it's an extra payment on the costs of the assets and the initial direct cost, the cost of the assets and initial direct cost. It's an amount that the lessor gets as something like profit on leasing his assets. So we'll get to understand that further as we move on. The finance charge is that it's a charge to the lessee, but when in the lessor's book it becomes a finance income. We'll see it further down. The total finance charge that arises over the life of the lease is the difference between the amount borrowed and the sum of all payments. That's like the gain to the lessor and the extra payment or the interest payment to the lessee. The interest payments by the lessee to the lessor, while it's a gain to the lessor. Now we'll have a format here. Lessee's minimum lease payments, sum of all payments made by the lessee to the lessor. Then we have the amounts on initial recognition, that's the cost of the asset. Then the difference gives us the total finance charge. We have example 14 here, total finance charge. Ibadan Construction enters a 6-year finance lease of a machine on 1st January year 1. The fair value of the machine at commencement of the lease is 80,000 and Ibadan Construction incurred an initial direct cost of 2,000 when arranging the lease. The annual lease payment is 18,000 payable at the end of each year. The estimated residual value of the assets at the end of the lease is 8,000 and Ibadan Construction has guaranteed this amount. The interest rate implicit in the lease is 11.176751%. Total finance charge. So we have to calculate that. We have the annual rental of 18,000 each year times the 6-year life. Let's see, 6 years life, then 18,000 annual payments. So we have a total of 108,000. Then we add the guaranteed residual value as a gain. We add the guaranteed residual value as a gain as 8,000. So the total gain is 116,000 naira. Then amount on initial recognition, that is the cost of the assets, which is 80,000, be gotten here. So we have the total finance charge as the interest, as the difference between the gain and the initial recognition itself. That's 36,000 naira as total finance charge or the interest paid on leasing the assets. Then we move over to example 15, allocation of finance charge. The same question. About your construction company enters into a 6-year finance lease of a machine on 1st January year 1. The fair value of the machine at commencement of the lease was 80,000, and Ibadan Construction incurred initial direct costs of 2,000 when arranging the lease. The annual lease payments are 18,000 payable at the end of each year. The estimated residual value of the assets at the end of each year, at the end of the lease, is 8,000, and Ibadan Construction Company has guaranteed this amount. The interest rate implicit in the lease is 11.176751. The same question. So we have a table here. We have the years, opening liability, the interest percentage, the lease payments, and the closing liability, the closing amounts owed to the leaseor. So we start from the fair value of the machine at commencement of the lease, which is 80,000. It will come as the opening liability, 80,000 down here. Interest rates implicit in the lease is 11.176751 given in the question above, of 80,000, which gives us 8,941. Then we have a constant lease payment of 18,000 naira per annum. So when we find the cumulative of these three, 80,000 plus 8,941 less 18,000, it gives us 70,941. We move the 70,941 down to year 2. Now the closing liability is the amount owed left at the end of the year. Remember, we talked about the interest, which is like a gain to the leaseor for leasing his assets. Now the interest at present value at year 1 is 8,941, which is 11%, 11.176751% of all opening balances. So when we look at it with the same method, the closing liability is moved over to the opening liability of the next year, and 11% is calculated on each opening liability. Then 18,000 is deducted from the balance to get the closing liability. Then on as a cycle, we get 0 at the end of year 6. So from this we find that the interest rate implicit in the lease here makes the total payments, the total gains that the leaseor is going to get, and his expenses equal to each other. That's 0 at the end of year 6. So we have it there. The interest expense is calculated by multiplying the opening liability by 11.176751% in each year, so as to provide a constant rate of charge on outstanding obligation. So we have accounting for finance lease, leaseholds accounting. Have the initial recognition. The leasehold records a receivable for capital amount owed by the lessee. This should be stated at the amount of the net investment in the lease. The net investment in the lease is the fair value of the asset, the cost of the asset. Illustration: double entry on initial recognition of finance lease. Now we have the net investment of the lease as a debit, then cash or bank as credit. Now the net investment of the lease is also the cost of the asset. The cash or bank is expended to buy the assets. So cash or bank is leaving the entity for a new asset, which is an investment as a lease. So we have it there. Cash or bank is credited, net investment of the lease is debited. Subsequent measurement of receivable. During each year, the lessor receives payments from the lessor receives payments from the lessee. Each receipt is recorded in the ledger account as follows. We have the cash or bank. So the lessor gets cash from his investment in the lease. Now the investment in the lease is bringing back cash to the lessor. We debit cash or bank, then we credit net investment in the lease. In effect, each lease receipt consists of two elements: the finance income on the receivable and a partial repayment of receivable, net investment in the lease. Now the net investment in the lease is the cost of the asset. The finance income is the gain that the lessee makes from leasing the asset. So in each payment the finance income is the gain that the lessor makes on the asset. Now from each payment from the lessee, there's a part of the net investment of the lease, that's the cost of the asset, that is recovered. So also a part of the finance income that is also recovered. The finance charge is recognized as income in profit or loss for the period. The finance charge, that's to the lessor, is also finance income to the lessee. The finance charge to the lessee, is also the finance income to the lessor and is recognized as income in profit or loss for the period, that is to the lessor. The partial repayment of the lease receivable reduces the amount owed to the lessor. We have a note on finance income here. The total rental receipts over the life of the lease will be more than the amount initially recognized as receivable. The difference is finance income. We've said that the total finance income that arises over the life of the lease is the difference between the amount invested in the lease and the sum of all receipts. That's it's a gain to the lessor for making the lease or agreeing to the terms of the lease. And we have an illustration here which gives us a format. It says lessor's minimum lease payments. That's to calculate the finance income to the lessor. The lessor's minimum lease payments, that should be less initial direct costs and the amount at initial recognition. Those two are costs, while the minimum lease payment is an income to the lessor. So we less costs from income, we get the total finance charge, the total gain on leasing the asset that goes to the lessor. The initial direct cost should be in bracket there, so also amounts on initial recognition in brackets, then the net value is the total finance charge. We have an example here. Kano Finance agreed to lease a machine to Ibadan Construction commencing on 1st January year 1. The lease was a 6-year finance lease of a machine on 1st January year 1. with annual lease payments of 18,000 payable in arrears. The fair value of the machine at commencement of the lease was 80,000, and Kano Finance incurred direct costs of 20,000 when arranging the lease. The estimated residual value of the assets at the end of the lease is 10,000. The lease has a guaranteed amount of 8,000. The interest rate implicit in the lease is 10.798%. So we have to calculate the total finance income. From the format, we got annual rentals 6 times, that's 6 years times 18,000 yearly here. Then we add the guaranteed residual value, which was given as 8,000. Now we were given a total residual value of 10,000, and they told us that out of the 10,000, 8,000 is guaranteed. So we could also say that the remaining part, which is 10,000 minus 8,000, 2,000, is unguaranteed. So for clarity, we split them out here. The guaranteed residual value 8,000, the unguaranteed residual value 2,000 will add it to the annual rentals. Total annual rentals will be 108,000 plus 8,000 plus 2,000, which is 118,000. That's the income on the lease. So we less the expense made on the lease. The first expense there is the cost of the asset itself, which is 80,000 here. Then the initial direct cost 2,000, which is also capitalized. So we have 2,000 plus 80,000, which gives us 82,000. Then we find the net, which gives us 36,000 naira. That is the finance lease. That is the gain that the lessor makes on leasing his assets. So we have finance lease disclosure. A finance lessor's disclosure. A finance lessor must disclose the following: A reconciliation between the gross investment in the lease at the end of the reporting period and the present value of minimum lease payments receivable at the end of the reporting period. Second, the gross investments in the lease and the present value of minimum lease payments receivable at the end of the reporting period for each of the following periods. First one, not later than 1 year. The second one, later than 1 year and not later than 5 years. Third one, later than 5 years. Then the unearned finance income, the unguaranteed residual value accruing to the benefit of the lessor, the accumulated allowance for uncollectible minimum lease payments receivable. I would say it again: the accumulated allowance for uncollectible minimum lease payments receivable, contingent rents recognized as income in the period, a general description of lessors' material leasing arrangements. So we have an example on accounting for operating lease. Now, throughout the periods, we've been talking about accounting for finance lease. Now we're moving over to the operating lease, which is a little bit easier. It says under a 4-year operating lease agreement, this is an example, entity F pays a non-refundable deposit of 50,000 and then 4 rental payments of 50,000 per annum on the first day of each year. So we have a deposit, then we have 4 years of 50,000 each. Now the deposit is paid at the initial year, the first year. So also does year 1 rather have 50,000 payments with it. So at year 1 we pay a total of 100,000, while subsequent years we pay 50,000. We'll check if that is correct. It said required, calculate the annual expense for the operating lease for each of the 4 years. B, calculate the asset or liability in the statement of financial position at the end of year 1 and at the end of year 2. So we have our answers here. Total lease payments 50,000, that is the deposit, plus 50,000 times 4 years each of the year. So we have 50,000 times 4, 200,000, 200,000 plus 50,000. We have the total lease payments of 250,000. Then the annual charge for the lease, we have 250,000 as the total lease payment. So if we divide it by 4 years, which is the period of the lease, given in the question. Let's look for it. 4 years, 4 years, yes, written here. We'd have an average of 62,500. That is to say that if we wanted to split the total payments equally, we would pay 62,500 for each of the 4 years, rather than paying an initial deposit of 50,000 first, then 50,000 prior years. So in the statement of financial position at year 1, we would have the following. We have the deposit payment of 50,000 plus the year 1's real value of 50,000 that is paid. That gives us a total payment for that year of 100,000, which shows we were correct. Then the supposed expense that was supposed to be made if it was shared equally, we'll less it, that's 62,500 from 100,000. That gives us 37,500 as our prepayment for year 1. That means, okay, we paid extra for year 1 by this 37,500 over what we would have paid if it was splitted equally, or if it was divided equally between the 4 years. So we have also for year 2, we would bring the balance from year 1, 37,500, then the lease payments that we make. Now the first year we paid 100,000, now subsequent years we have to pay 50,000. So for year 2 we pay 50,000. So the total amount we've paid for year 2 and subsequent years is 87,500. That's 50,000 plus our prepayments previously. Then we less the charge for this year, which was supposed to be 62,500. The balance prepayment at year 2 gives us 25,000 naira. So we have a prepayment at year 2 at 25,000 naira. Now the question says we should stop at year 2 in part 2, which we did right here. Now on operating lease disclosures, operating lease must disclose the following. 1. The total future minimum lease payments under non-cancellable operating lease for each of the following periods: A. Not later than 1 year, B. Later than 1 year and not later than 5 years, C. Later than 5 years, D. The total of future minimum lease payments expected to be received under non-cancellable subleases at the end of the reporting period. And we go further, the lease and sublease repayment recognized as an expense in the period, which separates amounts for minimum lease payments, contingent rents, and sublease payments. Further, a general description of the leases of the lessee's significant leasing arrangements, including but not limited to the following. First, the basis on which the contingent rent is payable is determined. The second, the existence and terms of renewal or purchase options and escalation clauses. And finally, restrictions imposed by lease arrangements, such as those concerning dividends, additional debts, and further leasing. It goes on to say operating leases in financial statements of the lessor. Because the lessor has not transferred the risk and reward of ownership in the operating lease, risk and reward is not transferred by the lessor of the physical assets to the lease. The lessor shows the leased assets as a non-current asset in its statement of financial position. Now in finance lease, it's the lessee that shows the assets in his books, while operating lease, it's the lessor that shows the assets in his books. It will be shown in an appropriate category of property, plants, and equipment at its carrying value as cost or valuation minus accumulated depreciation in respect of the leased asset. The lessor's annual statement of comprehensive income will include in profit or loss, that's the first one, depreciation on the asset as an expense as a regular treatment that we know. And the second, rental income, the rent it gets from leasing the asset to the lessee in an operating lease arrangement. This is usually calculated on straight line basis. Lease income from operating leases is recognized in income on a straight line basis over the lease term unless another systematic basis is more representative of the time pattern in which use benefits derived from the leased assets is diminished. Initial direct costs incurred by the lessor is in negotiating and arranging an operating lease are added to the carrying amount of the leased assets and recognized as an expense over the lease term on the same basis as the lease income. The depreciation policy for depreciable leased assets must be consistent with the lessor's normal depreciation policy for similar assets and calculated in accordance with IAS 16 and IAS 38. So that's the end of our part 2. In next class we'll move over to part 3 of lease, which would be treatments relating to the rather current noun IFRS standard on lease.